Welcome to the deep dive video update. And I always feel I need to explain the title because every week I do a number of different videos and I use a lot of charts in those videos. Well, at the end of the week, I look through all the charts and I pick out those that I really didn't talk about all that much and I put them into this video. There are also some other charts that are unique just to this video. And the reason I call this the deep dive video is because we have to really look deep to see, are these charts actually telling us something? Because the other charts that we look at in the other videos, yeah, they're speaking pretty loudly right now. But in this video, we have to just really analyze things a little bit closer. There are also some videos that are just unique only to this particular video. This is being prepared for Monday, August 12th. I want to announce that I do have a program. It's called the SPX Investing Program. It started in the beginning of June. It's still free for right now. If you want to access that, there's a link in the description below this video. There's also a link to other videos that will tell you more about the program. There's also an email address here if you want to contact me. And all of the videos that I do, as I mentioned, this is the deep dive video right here. And I do a number of videos. Most of them are weekly. I do supplemental videos on an as-needed basis, but they all feed into this center area, which is the daily video. And that's where you're going to get the best analysis and commentary to really understand what's happening in the market. All right, let's look at this first chart. This is a chart that I only use in this video, and it's only for informational purposes. This is the range of the VIX using a 50-period moving average. And we've been turning up lately. You can see way over on the right-hand side. But overall, as we've been coming up out of the lows that we had after the COVID crash and then 2022 and all that whole experience, the VIX has been a lot lower. Now, it really spiked up last Monday. And boy, even people that can't even spell VIX were talking about it, posting about it. They don't have any idea what it means, but they heard about it in the pop news. And it was really creating quite a ruckus because it really spiked up this past Monday anyway. Then we do another study here. This is the VIX, and then we do a ratio of the VVIX, which is the VIX of the VIX. And as a general rule, when this is going down, that tends to be more positive for the S&P. Well, now this is going back up, and that's been more negative for the S&P. And then we measure how fast is the VIX moving. Now, earlier in the week, I did use this chart because we really spiked up as the VIX. I mean, it closed up just under 40, but it got up above 65 intraday. And that's what I was saying, that people were making posts and talking about it, yet they have no clue what it is. If you watch the daily videos, you were not caught off guard by what happened last Monday at all. We were seeing it all set up and it all started to happen. And a lot of folks reacted to what was happening on Monday. I was closing positions for profits because I was already setting up bearish positions that took profits on Monday. Well, we saw the highest put volume pretty much in history on Monday. Well, then we went up massively on Tuesday. So people were buying puts to protect themselves. They lost because of that because they were too late. And then they bought the puts and then they went down in value on Tuesday when we went up with the S&P. So they lost like twice. And that's why I really, really focus on the daily videos, because we were not caught off guard by what happened. We didn't necessarily know the intensity or when it was actually going to happen, but we could see some things coming together. Well, the VIX really spiked up. Now it's back down more into a neutral range. All right, here's another study that we do with the VIX. It's a correlation between the VIX and the S&P. And as things were getting a little scary, we were starting to spike up here. This was kind of the beginning of when things started to switch over negative. Well, now we've really dropped down and it's not really giving us much of a reading at all. We also look at the skew index, which is like the VIX, where the VIX uses at the money options to be calculated. The skew index looks at out of the money options. And again, we were up into this red area when things started to get a little dicey. We weren't really deep into the red area, but then we dropped down from that. Now, one thing to be aware of is we're starting to go back up. We're not into that red area yet. I look at this chart every day. If this starts to go up into the red area, then I'll be including that in the daily videos. Then we are still 10.89% above the previous all-time high that was set in early 2022. Technical alerts, and my goodness, This is all red, and these are pretty much all Monday. There was a lot of damage that was done. It was kind of like a mini crash in a way, but we did find some support. Most of the real weakness that we saw came right at the open. There was some downward movement, and we didn't really bounce up out of that, but we were orderly. We stayed under control. And then since that time, we've been able to bounce up a little bit. Now we're still negative, and we need the market to prove to us that it's turning back positive, but we're not really seeing that yet, but it is showing some signs of improvement. So looking at the 5 indexes that I follow, the Dow, the S&P, the mid caps, the small caps, and the NASDAQ 100, coming in first place, which may be a bit of a surprise, is the S&P 100. Now, it's not giving us any kind of a great score at 60.2. When this is really solid, we want it in the high 80s, even into the 90s. That's when it's looking really good from a technical analysis perspective. This is the best looking chart right now. In second place are the diamonds. That's the Dow Jones Industrial Average, and it's coming in a distant second at 42.7. Then we have the mid caps at 40.6, the small caps at 35.4, and yes, the QQQs, the NASDAQ 100, for the second week in a row are coming in last place here at 23.9, showing a little bit of improvement. Believe it or not, they were looking worse than this. We actually dropped under 20 when things were not looking so good. So we've actually shown a little bit of a pickup here. If we're going to turn back positive, we need the QQQs, the NASDAQ 100, the mega caps, the big large caps, the tech companies. We need them to start coming back into favor. Are we turning more defensive in the market right now? Because we're seeing areas like utilities and healthcare and staples. Those are the areas that are doing pretty good. And those are typically the areas that the smart money gets into before we're getting ready for a decline. That's what we're trying to figure out on a day in and day out basis. All right, looking at a short-term rainbow chart here, where we are somewhere under the rainbow right now, as we have fallen below all of the moving averages. And the short-term trend is negative. When we look at all of our different charts, we're working off being extreme negative right now, but still, we need a lot of upward movement to repair the short-term trend. Intermediate term, here's another rainbow. We're also coming down underneath the rainbow, but we were able to bounce back up to the underside of the rainbow. And looking at the CMB, composite, we are not getting any kind of an extreme negative or positive reading. I use this like an oscillator when we go above or below the black lines. Then the Connors RSI, I did show this because we were giving an extreme negative reading after Monday, but most of the time it looks pretty sporadic here, but we spend most of our time not going extreme positive or negative, and that's where we're at now, is in between. And then this is something interesting that I was looking at this chart going, do you notice sometimes when we get about 15% or so above the 200-day moving average, that's when we start to run into problems? That's what happened back in April, and it's what's happening now in July. And you see, we were 15% above the 200-day moving average. We were getting kind of far. Now, I show this in some of the other charts by saying that we're looking a little extreme positive, and I use other indicators to do that. But then, and I'll show you this in another chart too, where we started really coming down, and we were getting close to, from the top all the way down to the bottom on Monday, we were getting close to that 10% mark. And I'll show you that again, but I just thought this was kind of interesting. So when we get into that 15% away, I'm going to start tracking that. I'll probably create some different charts to go along with that if we ever get back there. Of course, it could take a while for that to actually happen. All right, this is another chart that I was talking about, and this is a little bit different. When we measure from the lows that were set back in 2023, and even after Friday's close, we're still up 23.13%. What I did is I started looking at the intraday high that was set on July 16th, and then we were just screaming to the downside here. Most of it was the gap. And I said, okay, we're just about to that 10% level. Now, this is the definition of when we fall 10% from the previous high, in this case, an all-time high, that's when we label this a correction. Usually when we're down 2, 3, 4, 5%, that's just a decline. From 5 to 10% is an actual pull. I'm sorry, 3 to 5, about 5% is a pullback, and then 5 to 10% is a decline. And then if we drop down below 10%, that's when we actually go into a correction. And I wasn't the only one seeing this. We saw there's a lot of smart money out there who was going, we're getting pretty close. We were sitting at some intraday support at that point. And so the smart money started to come in and actually buy. Now, we didn't see much of an advance on Monday, but we didn't see much more of a decline either. And so we built kind of a base to come up out of. And then since that time, we've been coming up. Now, we're not turning positive yet. We're still looking negative. If you notice here, all we've done now is we've gone back and we filled this gap from last Friday to Monday. And sometimes when gaps are filled, that's when we see some problems along the way. You notice here that we had a gap. Where was this? I was looking at this earlier. There was a gap that we eventually filled in and then really started to go down. Right here. This is the gap. Sorry about that. Right here. We came back up, filled that gap, and then boom, that's when we saw the declines really take place. Are we going to see something like that in the upcoming week? We don't know yet, but it's something just to watch for. All right, then looking at the S&P 500, and the S&P 100 has really been underperforming lately, and those are the biggest stocks that make up the S&P 500. So we want those to catch some fire if we're going to turn back more positive. And the Pring bottom fisher, well, it was generating a signal as we were going down, and now it's generating nothing as we're really going down here. So really, this is an irrelevant signal at this time. We're not getting an extreme reading. We did after Monday. We actually closed down below the lower Bollinger Band, which doesn't happen very often. And once it does happen, it doesn't tend to stay that way for very long. And then we were able to bounce up out of that. Now we're still below the midpoint, so we're negative, but we're no longer extreme negative with this chart. And then we were getting really extreme in our distance away from the 20 period and even the 50 period moving average. We've been able to bounce back up a little bit, and we're showing some improvement along the way, but we're still negative. We're also seeing a little bit of deterioration, but not quite as negative when we measure the distance from the 200-day moving average. Okay, then a long-term rainbow. We're just coming right back down into the middle part. We haven't really done a lot of damage yet to the long-term trend. The longer we stay in here, or if we keep going down, the more these lines are going to start to roll over. But at least to this point, we really haven't we haven't been here long enough to really make the lines turn. And then here's our long-term oscillator where we are coming down, but we're still above the moving average. So it's still positive, but it is showing some weakness. And then we look at a weekly chart of the S&P and a weekly chart of the German DAX. They're not really correlating very strong right now. The S&P has actually been holding up better than Germany has, if you can believe that. All right, then here's one support chart. This is mainly focusing on the short-term trend based on 20 periods of moving averages. This is just the open, high, low, close. It creates its own little mini rainbow. And we're far away from this now, so I haven't been showing it. And now that these lines are rolling over, this is showing that the short-term trend is turning more negative. Some broad market measures, we look at the Dow and the transports. They both have been under pressure lately, with the transports really just not doing very well at all in 2024. And we look at the S&P and then a ratio of the Qs, the NASDAQ 100 to the diamonds, which is the Dow. And we see that they're fairly strongly correlated right now. They may be both going down, but they're going down together. And then here's the Vixen. Gotta love that name. It really spiked up too, but then came down well off of its highs, but it's giving us much, much higher readings, anything that we've seen so far in 2024. So just showing the volatility, not only for the S&P as measured by the VIX, but here with the Vixen, it's also giving us some high readings. And then we look at a ratio between the regional banks and the financial sector. Now, the financial sector is doing pretty good, and it's actually back above its 50-day moving average. But we were seeing a real improvement here with the regional banks. Well, now this is starting to come back down, and we're still in a downtrend here. If we fall down below the moving averages, it's going to keep this trend negative with the ratio. And a couple of rate of change charts. We are seeing a little bit of a fall off here with this one rate of change chart, as well as this other rate of change. And this is so long, I just use them in this video unless something really major happens. But I have other charts that really turn more drastic than these charts. Then looking at the long-term bond ETF, which is in blue, and that had really been going up, it fell back and then had an up day on Friday. Where we look at the S&P, which has been going down and then it's been bouncing back up, we see that the longer term correlation between the two is starting to weaken, and the short term correlation is that they're actually going in opposite directions right now. And we look at another ratio here of a correlation between the Qs, the NASDAQ 100, and the long-term bond ETF. They're also having more of a tendency to go in opposite directions. We have bonds that are seeing some favor right now and going up with price, down with interest rates, and we're seeing stocks going down with price. And then here is a look at the 10-year yield in the US, subtracting the 10-year yield in Germany. And then we plot the US dollar index down below, and there's a pretty strong correlated relationship between them currently. And they're both in decline right now as interest rates are going down, both in the US and in Germany. And the dollar has been under pressure lately. And then looking at the yield curve, we actually went uninverted for a brief period of time in Monday's session with the 10 to the 2-year, but we're still below this red line. We're still inverted here. We have a ways to go with the 10 to the 3-month. The other ones, these are other yield curves that I plot, but they're really not as important. It's the top two, the 10 to the 2-year and the 10 to the 3-month. That's what the market typically follows. Then we have some different studies here. These are the percent of stocks in the S&P above their 200-day simple moving average. We are still above 50. So longer term, we're still looking okay for right now. And then stocks above their 50-period moving average, we're just a little bit above 50 after seeing some weakness here in the S&P. We're actually below 50 now with the mid caps, and we're even a little bit further below 50 here now with the small caps. And then this is a chart that I was showing for quite a while because we were getting quite extreme positive readings. This is the 10-day average of the S&P 500 highs minus the lows, and it camped out here for a lot of 2024. Then we saw some weakness in April. Then it was starting to look strong again. Well, now it's starting to drop back down. And then looking at the 2-year Treasury yield, what can happen sometimes is when we really spike up here, and this almost looks like a head and shoulders top, but when we spike up and start to come down, that will often give short to intermediate term support to the S&P. Well, we've been coming down, but that really hasn't been helping. We have to look at the context. Why are interest rates going down? Is it because the Fed may be cutting rates to try to stimulate the economy? Or are they going down because there's fear of economic weakness and the Fed may be cutting rates for that reason, and that puts it more in the negative category? So thank you. I really hope you're having a great weekend, and I will talk to you in the next video.